lot about how to react when things go wrong, but perhaps we talk too little about what happens when everything starts going right. It may seem strange to treat a positive streak as a problem, because naturally that is what we hope to see when developing and validating a method, a model. But there is an important difference between a model producing good results and you starting to believe that those results prove you are seeing something that others are not. It is a small shift in the way you think, but it can completely change the way you make decisions. Imagine that you start using a method and the first results are good. Then another positive result comes, then another, and the curve starts to look good. The uncertainty that was there in the beginning gradually disappears, and you become increasingly confident in what you are doing. So far, so good. The problem begins when confidence in the process starts turning into confidence in the next result. You look at a situation and think, this one is very clear. And perhaps it really is according to your model's criteria, but that does not mean it has stopped being probabilistic. A 65% estimate still carries 35% on the other side, regardless of whether you are right in the last 5 similar situations. This is where a positive streak can create a curious distortion. You start attributing a level of precision to the method that is never promised. Maybe you increase your exposure because this case looks very good now. Maybe you accept situations that would previously have fallen outside your criteria, or maybe you stop recording a decision because you already know the method by heart. Little by little, what was actually validated gets replaced by a more flexible version, based on the feeling that you have finally figured out how it works. And the most dangerous part is that, for a while, the results may still continue to be good and reinforce that behavior. If you think about it mathematically, a streak of correct outcomes is not necessarily evidence that the probability of the next events has increased. It may be consistent with the expected quality of the model, it may represent a favorable period of variance, or it may be a combination of both. Distinguishing between those possibilities requires sample size, calibration, and monitoring. What does not make sense is concluding that 5 or 10 positive results have transformed a probabilistic estimation into something close to certainty. The model did not become better simply because its recent results were good. And there is a question I find useful in moments like this. If I were coming from 5 negative results, would I make exactly the same decision with exactly the same level of exposure? If the answer, my friend, is no, it's worth investigating why. Perhaps you are not reacting to the characteristics of the current event, but to your own recent story. It is the same mistake as revenge trading, only with the sign reversed. In one case, you increase your exposure because you want to recover what you lost. In the other, you increase it because you start believing that you are the god of trading. You are especially right. In both cases, information that should be irrelevant to the current decision, the outcomes of previous operations, starts influencing what you do now. That is why a method also needs rules for when things are going well. Entry criteria, maximum exposure, risk limits, and conditions for stopping or reviewing the model should exist before the streak begins, precisely so that they are not redefined according to the emotional state of the person executing the method. If there is enough statistical evidence to change something, great, fantastic. You go back to the data, test the hypothesis, and create a new version of the method. This is data science. What should not happen is a silent change simply because you are going through a good period and have started trusting your own perception more. This is the trap. Perhaps this is one of the most interesting tests of maturity in any probabilistic activity. It is relatively easy to say that we need to respect the variance while studying a spreadsheet or a Python code. It is harder to keep respecting that same variance after a streak in which it feels like you cannot get anything wrong. A bad streak can make you want to recover what you lost, as I said. A good one can make you believe you have discovered how to not lose. Both feelings are dangerous for the same reason. Neither of them changes the probability of the next event. So pay attention, trade safe, and believe in what I'm saying. This will happen to you if this has never happened before. Trade safe, take care, ciao.